And ultimately what this means is when things are going well, prices are going up faster. But what happens when things turn for the worst? The same mechanisms that push prices up rapidly now work in the opposite direction as speculators hurry to get out. Today we are seeing investors leave the real estate space in record numbers, sparking a serious downturn in values. According to a Redfin report, investor home purchases fell 30% year over year nationwide in the third quarter, the largest decline since the Great Recession, aside from the second quarter of 2020. This is when investor activity plummeted due to the onset of the pandemic. The damage in boom towns like Phoenix is even worse. There, investor purchases fell 50% year over year. This has profound effects on the marketplace as a showcase of pure market panic by those with billions of dollars at stake. Just to put this into perspective, let's look at one specific shocking example. But before we do, if you're enjoying the video thus far, please take a second to hit that like and subscribe button. The last video got over 2,000 likes and I hope to get this one to 3,000. Now back to the example. One of the biggest single-family investors in America is a company called Opendoor. Their supposed specialty is to use software/AI to buy certain homes and then resell them weeks later. Now remember, this is just one company. We are not counting the dozens of other institutional players in the space on top of the thousands of other mom-and-pop investors with much smaller portfolios. Opendoor by itself accounts for 9% of all active listings in Phoenix. This absurd stat means that they have significant pricing power in that market. Somehow in this country, we have a rule that when you buy more than 5% of a publicly owned company, you have to register with the SEC and follow all kinds of special rules. But when you buy 10% of an entire major city, you have free reign to do whatever you want. What this does, or at least influences, is this: absurd price growth. The median home price in Phoenix in January of 2020 was $275,000. Earlier this year, it had jumped 70% in less than 24 months to $474,000. Now, of course, it's not just investors causing this rapid growth, but with nearly unlimited cash and greed, the correlation between investor share and boomtown is quite obvious. Throughout the US, wherever we see large institutional ownership, we also see massive speculation and crazy growth. So what does all of this have to do with the crash or downturn? Well, as I suggested earlier today, the market has changed compared to the days of 2008. Today, the large Wall Street investors are a significant force in the markets, and while everyone likes to believe these multi-billion-dollar companies with sophisticated algorithms know better than everyone else, it turns out this couldn't be further from the truth. Wall Street is confused like everyone else, caught off guard by one of the most significant downtrends in US history. Their algorithms are tuned with data that only looks at things post-2008, an era with low unemployment, low interest rates, and steady housing growth. It ignores the many risks the market hasn't experienced in decades. Companies like Opendoor are getting a harsh lesson. How can you possibly make money flipping houses when every month values are going down by thousands of dollars? This reality is represented by their stock price, which is down over 95% from its peak. Earlier in the month, their earnings report revealed just how little they understand regarding the future of markets. The company itself admits that the housing market will likely only get worse, saying, quote, "We think that the housing market could get worse. We haven't seen US home sales dip below 4 million units a year in decades." The truth about Opendoor and all the other institutional buyers is that they're panicking and dumping inventory as quickly as possible. This isn't just a theory. Their CEO admits this, saying, "I just wanted to note that other iBuyers have sold 40% of the inventory that they bought in Q2, and we sold 67%. So we have a large head start on liquidating our inventory." This is a man bragging that his business is getting out faster than his competitors. In fact, the entire business model is changing. Opendoor itself is moving to become less of a flipper and more of a listing/data aggregator. The race is now not on who can buy more homes and increase margins, but rather who can survive and liquidate their inventory as fast as possible. So with that said, the market has never experienced anything like this. We have record high investor market share and they're all dumping their inventory at the same time. On top of this, demand is falling off a cliff. The theory is that after the pandemic, there was a fresh wave of people forming new households. Many who lived with parents or roommates during the lockdown got out, and now we're seeing a sharp drop off. This combined with high interest rates and prices 38% higher than pre-pandemic levels are creating a never before seen scenario. This morning, US pending home sales fell 37% year over year, the worst decline in history. And if you look at this period, it's starting to look a lot like the one we saw 14 years ago. While back then the issue was with bad loans, today the problem may come in a different form, a perfect storm, a bad economy, folding demand, and an institutional withdrawal. It's no surprise that many of you watching watching this video will scream that there is no crash. Prices remain elevated compared to those we saw in 2019, and we have a long way to go before we see this normalize. But just like last time, the housing market almost never falls off a cliff. It's a slow bleed that takes years to play out. If we look at a boomtown like Phoenix, for an example, the last time there was a crash, home prices did something incredible that's almost never mentioned. If we take a look at home values during that era, we can see from this chart that they peaked in the fourth quarter of 2006. After the downfall started, they fell for over 18 quarters or 54 months. That's 4.5 years of decline before they finally bottomed out in the summer of 2011. In fact, if we pretend you were the world's unluckiest buyer and you had bought a home in the winter of 2006, you wouldn't have seen your equity recover until the summer of 2019. That's over 13 years of waiting, and it goes to show you that things in the real estate space move.
The automated Amazon store are totally different than all the rest of them because we guarantee your profits and the time frames that you make up and that your store will never get shut down. Nobody
move very, very slowly. The damage takes months to play out, and the recovery is typically even longer. Now that we understand this, there is another major factor that will make this down cycle even worse. You see, real estate investors look at something called the cap rate to determine how much money they can expect to make every year given their investment. Right now, cap rates are averaging between 4 to 10%. And remember, residential real estate isn't exactly the most risk-free investment. It's a good investment, but as you're about to find out, there is an alternative that's even better given certain conditions, one that competes with real estate head to head. We know that the better the property, the more reliable the renters, the less the risk. For good properties where risk is low, cap rates are towards the lower end of that scale. And now with the Federal Reserve raising rates, this is making bond yields rise to the point that it's starting to interrupt real estate investment. There are no rational people or organizations that will put money into a real estate investment when they can easily buy bonds and get similar returns without any of the headaches related to investing in homes. Right now, the 5-year bond yield is at 3.68%. It was at one point earlier this year up to 4.39%. The more this bond yield rises, the less likely investors will be willing to put money into residential real estate. As this continues, the complete withdrawal from markets becomes more and more apparent. If for one reason or another the Federal Reserve continues to have problems taming inflation, it will be forced to raise rates higher and higher, and after a certain point, bonds will start to look more and more attractive, competing with all sorts of investments. This will suck money out of the real estate market, especially with institutional players who will have a near impossible agenda, making money in a long downtrend. Just as I showed with the Phoenix example, these cycles can last for decades, and every rational institution will look to get out if bond yields continue to rise. This perfect storm scenario is why we're seeing so many already jumping out and why values have started to turn around in a way that we haven't seen since 2008. While many are quick to dismiss this reality, stating that prices still have a long way to go, the truth is very simple to understand. If prices can go up 15 to 20% in a year, there is no reason why they cannot go down in the same time frame. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed the video, and make sure you drop a comment below. I would love to hear from people in the Phoenix market who were buyers in that pre-crash era.